You wanted to make some moves to lower your 2020 taxes, but now we're into 2021 and you're feeling like it's a little too late. But there are a couple of things you might still be able to do to lower your last year's taxes, and they also might help you build some wealth in the process. Let's make sure you haven't missed out. And for any of you DIY tax filers, I'll also share how you can save some money when you file your taxes online. Welcome to Healthy, Wealthy, and Wise, the channel that's dedicated to making sure you have the information necessary to ensure your physical and financial health. As we're now into tax filing season, I thought there's no better time than now to talk about taxes. While it's true that a lot of things have to be done before the end of the calendar year to save on your taxes, there are a couple of things that still can be done to help reduce your tax liability. In this video, I'll go over those with you, as well as share how you can save some money on getting your taxes done, if you're like me and prefer to do them yourself. Alright, so let's say you didn't make that contribution to a charity or have a baby before December 31st. What else can you do? Well, depending on your own personal situation, there may not be much you can do, but there also could be an opportunity for many of you, and that's what we're going to talk about today. Before we get into it, please keep in mind that I'm not a financial advisor nor a tax attorney, so please be sure to do your own additional research or consult with your own financial advisor for making the best decisions for you based on your own unique situation. Alright, so probably the best strategy you can follow to lower your taxes after the end of the calendar year is to make sure you fully funded 2 primary accounts as allowable within IRS guidelines. And the great thing about these 2 accounts is that it doesn't matter if you itemize or use a standard deduction. So if you don't go through the tedious process to itemize your deductions, you can still deduct qualified contributions to your accounts. And the 2 accounts that we're going to talk about can not only save you on your taxes, but they can also help you grow some wealth because they can both be used as investment tools. The first account we'll talk about is fully funding a health savings account, commonly known as an HSA. Wait, you say you don't have an HSA already? Well, depending on the medical plan you had last year, you still might be qualified to open one now and be able to apply new contributions to lower last year's taxes. I've had a couple of videos in the past on understanding HSAs and how to use them in the best way, and I'll link the most recent one to you in the description because I'm not going to repeat all the information from those today. There's just too much. But if you're not very familiar with HSAs, I would strongly recommend you check that video out first. Now, if an HSA is something you definitely would like to pursue, the primary thing you will need to do is to verify that you had a high deductible health plan in place last year that meets HSA qualifications. The main criteria for a qualified high deductible health plan for an HSA for 2020 is that for singles, that the plan had a minimum deductible of $1,400 and a maximum out-of-pocket deductible of $6,900. For family coverage, the minimum deductible is $2,800 and the maximum out-of-pocket deductible is $13,800. The numbers come right from the IRS itself in publication 969 if you want to look into it yourself. Another thing you could do just to make sure your plan in 2020 met the criteria is to call the health insurance company and ask if your plan met HSA eligibility. Keep in mind that even though you can apply your contributions to a new HSA to last year's taxes, you can't use those contributions to pay for healthcare receipts dated before your HSA was opened. Now, another red flag into doing this is if you didn't have a qualified high deductible health plan for all of 2020 and are not going to have a qualified plan in 2021 or plan to transition to Medicare sometime in 2021, you are at risk for taking a tax penalty based on the last month rule and testing period. Again, I'm not going to talk about this in today's video. You just want to remember that if you didn't have an eligible plan for all of 2020 and won't have one in 2021, you want to be very careful in setting up a new HSA without getting professional guidance on how much you can contribute and avoiding the penalty. Alright, now let's say you've opened a new HSA or you already have one. At this point, you just need to know the maximal contributions that you're allowed to make and then review what contributions you might have already made. And remember that any money that your employer contributed to your HSA, if they did that, goes towards your annual contribution limits. Those limits for 2020 are, for self-only coverage, you can contribute a total of $3,550. And then if you have family coverage, your total annual contribution limit is $7,100. Now, if you were over the age of 55 by the end of the last year, you can contribute an extra $1,000. So getting back to the purpose of saving money on your 2020 taxes, the gap between the annual contribution limits for the type of coverage you have and the actual amount of contributions made to your account by you and your employer is how much money you can put towards last year's contribution to your HSA. So for example, If you're single and put in $2,000 throughout the year and your employer kicked in another $500, that means you have contributions totaling $2,500. Since the contribution limit for self-only coverage is $3,550, your gap is $1,050, meaning you could still make a contribution to your HSA for 2020 up to $1,050. And you have until April 15th, 2021 to do this. But a real critical point to keep in mind is that when you make the contribution, you need to make sure that it is applied to 2020 and not 2021. Obviously, you can make contributions for 2021 as well, but they wouldn't count until your 2021 taxes. Unlike the next account we'll talk about, there are no income limits for making tax-deductible contributions to an HSA. The only thing is you just have to make sure that you had a qualified high-deductible health plan. There are so many advantages to an HSA for a lot of people, again that I talked about in previous videos, that I wish I'd started one for myself years earlier. I just didn't understand all the good things about them, including the triple tax benefit. But now that I do, I've had one for a few years now and I've been pretty happy with it. Okay, so there's another account that, depending on your income, and if you have an employer-sponsored retirement account, such as a 401k, you might be able to add money to be applied for last year's or 2020's taxes, and that's an IRA, or an individual retirement account, or arrangement as defined by the IRS. Now there are two main types of IRAs that are out there, a traditional IRA and a Roth IRA. For today, I'm talking about how to lower last year's taxes, so we're talking primarily about a traditional IRA. The basic difference between the two types is that with a traditional IRA, you don't pay taxes until the money comes out, whereas with a Roth IRA, you pay taxes when it goes in. And because of that, there really isn't a benefit to your tax bill for 2020, although there could still be benefits of starting a Roth IRA now. But hey, that's a topic for another day, because today I want to focus on reducing last year's tax bill. Now, unlike 401ks where your contribution generally has to be made by the end of the calendar year to count for your 2020 taxes, a traditional IRA has a deadline up until April 15, 2021, just like with an HSA. So whereas if you didn't fully fund your 401k, you still might have the ability to open an IRA and contribute up to last year's limits, but like with an HSA, you want to be clear that you're applying it to 2020 and not 2021. It's a little harder to figure out what you can exactly contribute to an IRA for it to be tax deductible depending on your situation, but I'll give you some basic guidelines. So let's look at guidance for IRA deduction limits right from the IRS webpage for 2020. We'll start easy and assume that either you file single or if you're married and file jointly, both you and your spouse do not participate in an employer-sponsored retirement plan. In that case, you can see on your screen that there are no income limits for you to be able to deduct 100% of what you contribute up to the contribution limit, which I'll share what those are in a minute. So let's now change it up and say you do participate in a work-sponsored retirement plan and you have an adjusted gross income of $65,000 or less and you file single, or $104,000 or less for married couples filing jointly. If you meet that criteria, you can still fully deduct up to your contribution limits. But as you can see, as your income goes up, the percentage you can deduct starts to reduce until you reach $75,000 for a single filer or $124,000 for a joint filer, where when you reach those income levels, you can no longer have your contributions to an IRA be deductible at all. One more scenario is if you don't have an employer-sponsored retirement plan, but you're married and your spouse does, and you file jointly, you can still take the full deduction up to the contribution limits for income of $196,000 or less before it starts to phase out. Now, I realize you may not know exactly where you fall within your modified adjusted gross income levels before you file your taxes. If you're like me who does file your own taxes, you'll want to work on them to get that number, but just make sure you don't actually file them if you're planning to make a contribution to your IRA. If you're in those phase-out levels of the deduction, your tax preparation software or your tax professional you work with can help you decide what your actual deduction number is. Next, we need to talk about contributions and what the limits are for 2020. On your screen, you can see that if you're under 50 years old, you can contribute up to $6,000. And if you're 50 or older, you can contribute an extra $1,000 or $7,000 total. So depending on your situation, and if you didn't already contribute to those limits, you can still make any additional contribution for 2020, again, just making sure you identify it for 2020 and not 2021. And while you may be married and file jointly, both you and your spouse can each have your own IRAs. And as you can see on the screen, your total contributions to both your IRA and your spouse's IRA may not exceed your joint taxable income or the annual contribution limit on IRAs times 2, whichever is less. So those are the two primary ways that you can use to reduce your taxes for 2020 even though we're now into the new year. Obviously, there are a lot of unique situations out there, but I'm really just trying to share information that can be helpful to a lot of people in general. For anyone that has a complicated tax situation, you probably would benefit by working with a tax professional. Now, however, if you're like me, you like to do your own taxes. Okay, maybe like isn't the right word, but you prefer to save some money and do them by yourself. Depending on your income and how complicated your taxes are, including if you take a standard deduction or itemized, you have a lot of online options to file your taxes. And some of those are free. A lot of people don't realize that and take their taxes somewhere and are then charged a lot for the convenience of not having to think about it, even when their tax situation might be pretty simple. But since you're watching this video, I'm going to assume that you like to save money, so I want to give you some options to help you save some of your hard-earned cash, while still qualifying that if you just feel like it's too hard or too stressful, going to a tax professional might be worth it for the peace of mind. But if you're all in on doing your own taxes, let's talk about your free filing options first. As you can see on the screen, if your adjusted gross income is $72,000 or less, you can file for free with IRS-approved partner sites where those sites will guide you into filing your taxes easily. Some of those partner sites include some additional guidelines or perks, so you can check out each one by clicking on the blue box that says Choose an IRS Free File Offer. Now, if you don't meet the criteria because your income is above the limit, you can still file by filling out electronic forms. Just keep in mind that there is little to no guidance with this option, so you might want to be careful going this route if your financial or tax situation is a little more complicated. If you file wrong and miss some deductions you deserve, you might have been financially better off by just biting the bullet and going to a tax professional. Now, what I've done for over 20 years now is use TurboTax from Intuit. And I've used it because my tax situation has gotten more complicated over the years, and the program is easy to follow and does give you guidance on how to file your taxes effectively. Now, I want to be clear that I'm not being sponsored by Intuit or TurboTax. I'm just sharing the program I use when I file my taxes because I've been pretty happy with it. They've added a lot of user-friendly features over the years, and now even have live support if you need it. And once you use it one time, next year it's even easier because a lot of your information pulls over. Depending on your needs, they have different products which come at different prices, so you can pick and choose what's best for you. If you've not used TurboTax before, I do have a discount code that I'll link in the description where if you click on it, you can save 20% on any of the products you use to file your federal taxes. Once again, I'm not being sponsored by Intuit, but if you do use the link for the discount, I want to be completely transparent that I would be eligible to receive a small reward. Having said that, I would not be talking about TurboTax if I wasn't using it myself, like I said, for over 20 years. So if you're interested in giving them a shot and like to save 20%, check out the link that's in the description. So what do you think? Is there anything else that you've done to lower your taxes legally after the new year has begun? Let us know in the comments. Like everyone else here, I'm always willing to learn more. I really hope you found this information helpful, and if you did, please like the video, subscribe to the channel, and share the video with anyone you think could find it helpful. Sharing it on any of your social media sites is a great way to help spread the word. As always, I hope that we can all learn from each other on how to take little easy steps in making big improvements in our lives. Thank you again for watching, and until next time, have a great day.